The first set of principles explain how people make decisions. Principle number 1: people face trade-offs. Because resources are scarce, we cannot have everything that we want. To get something that we like, we have to give up something else that we also like, which is our trade-off. Think about what are the trade-offs of going to a party the night before an exam. Well, the trade-off would be getting a good night's sleep before your exam. If you want to have more money to buy more stuff, well, then you will have to work more hours. If you work more hours, you will have less time for, let's say, travel or rest and so on. If you want to protect the environment, you will have to navigate more resources towards protecting the environment. Then you will have fewer resources for, let's say, healthcare or education. Now think about, your government spending more money on infrastructure. If your government spends more money on infrastructure, they have less money to spend on healthcare. If they spend more money on healthcare, they have less money to spend on national defense. So everybody faces trade-offs. People face trade-offs, the government faces trade-offs. The society as a whole also faces trade-offs. If the society spends more on national defense, then it has less resources to spend on, let's say, consumer goods, goods that you and I consume. Another societal trade-off is between efficiency and equality. Efficiency basically means that the society gets maximum benefits from its scarce resources. So if a society wants to be efficient, it is going to navigate most of its resources towards workers who are the most efficient and little to no resources to workers who are not very efficient. But this increases inequality. But if a society wants to be equal, prosperity is distributed uniformly among society's members. But then there's a decrease in efficiency. So when society decides to increase efficiency, there's inequality in the society. If the society decides to be more equal, there's inefficiency in the society. So the trade-off is between efficiency and equality. To achieve greater equality, we can distribute income from the wealthier people to the poor people, but then again, this would reduce incentive for the most efficient workers of the society to work and produce, which decreases the size of the economic pie or the total wealth of the economy. Principle number 2 is the cost of something is what you give up to get it. Because people face trade-offs, they need to compare the costs and benefits of different decisions that they are making. In many cases, these costs are not always as obvious as you think. Economists say that in order to calculate the total cost of doing something, we have to include opportunity costs. The opportunity cost of doing something is what you give up to get that. Let's use some examples. What is the total cost of going to college for a year? Well, we would obviously include tuition, books, and fees. Probably not room and board, because you would be paying for room and board even if you're staying somewhere else. Again, second example, what is the total cost of going to the movies? Well, the more evident cost is the price of the movie ticket. But we are missing something here. This ignores the cost of your time. When you listen to lectures, read books, and write papers, you can't spend time working and earning money. The time that you're spending in the movies, you could have picked up an extra shift at your job and earned $10 an hour. So you see, when you calculate the total cost of doing something, you have to include the opportunity cost of doing that. The opportunity cost of doing something is what you're giving up to get it. So the total cost of going to college for a year is the cost of tuition, books, and fees, plus the foregone earnings that you would have earned if you were working full-time, which is the opportunity cost of going to college. The total cost of going to the movies is the price of the movie ticket that you pay, plus the value of your time that you spend in the movie theater, which is the opportunity cost of going to the movies. Principle 3 says, rational people think at the margin. So economists assume that all people are rational. Rational people are those who systematically and purposefully do the best they can to achieve their goals. But what do we mean by thinking at the margin? Thinking at the margin basically means that people make decisions by evaluating costs and benefits of marginal changes. Marginal changes are small changes. So basically, it's like thinking about how much money will I make if I pick up one extra shift at my job? How much will I earn more if I work for one more hour? What benefit will I get if I sleep one more hour tonight? These are marginal changes. So economists say that rational people make decisions by evaluating the cost of one more unit of something or the benefit of one more unit of something. So let's do an example. As the manager at the local price cutter, you are thinking of hiring one more cashier that would increase sales revenues by $400 per week. The new cashier would earn $300 per week. Should you hire the new cashier? Why? Remember, rational people always think at the margin. Think about what is the manager's marginal benefit of hiring one more cashier? And what is the manager's marginal cost of hiring one more cashier? And the answer should become clear to you. The marginal benefit of hiring one more cashier would be increase in sales by $400 per week, and the marginal cost of hiring one more cashier would be paying them $300 per week. So the net benefit of hiring one more cashier at the local price cutter would be $100 per week. Because the marginal benefit exceeds the marginal cost, the manager should hire the additional cashier. Principle number 4 says, people respond to incentives. An incentive is something that induces a person to act in a certain way because it gives them a net benefit. People respond to incentives because people are rational. Rational people always think at the margin. Rational people think about the marginal benefit and the marginal cost of doing something. And so if the marginal benefit of doing something is greater than the marginal cost, people are going to want to do that activity because people have an incentive to do that activity. For example, if there is an increase in the price of donuts, consumers will buy fewer donuts. Why? Because now the marginal cost of buying that extra donut is higher than the marginal benefit. So this is a disincentive, the opposite of an incentive. So they're not going to buy as many donuts as before. On the other hand, an increase in the price of donuts is an incentive for the sellers because now they can sell the donuts at a higher price. So an increase in the price of donuts induces sellers to produce more donuts because now they can sell the donuts at a higher price. It's an incentive for sellers. Now let's look at a numerical example of this principle. Suppose that you're selling your black 1967 Chevy Impala. You're tired of spending money on it. You've already spent $2,000 on repairs. At the last minute, the transmission dies. You can pay $1,400 to have it repaired or sell the car as is. In each of the following scenarios, A and B, should you have the transmission repaired? And explain. Scenario A says, Blue Book value, that is what you would get for the car if you sold it, is $14,500 if the transmission works when you're selling it, or it's $11,200 if the transmission doesn't work. Scenario B says, Blue Book value is $12,300 if the transmission works, or $11,000 if the transmission doesn't work. Question is, do you have the incentive to get the transmission repaired? Think about marginal benefits and marginal costs, and if you have the incentive to get the transmission fixed. The marginal cost of fixing the transmission is $1,400. But what is the marginal benefit in each case? In scenario A, the marginal benefit of fixing the transmission is the Blue Book value if the transmission works minus the Blue Book value if the transmission doesn't work. So the marginal benefit of fixing the transmission is $3,300. In this case, the marginal benefit of fixing the transmission is higher than the marginal cost, which is $1,400. So in the case of scenario A, we do have an incentive to fix the transmission. In scenario B, the marginal benefit of fixing the transmission is the Blue Book value if the transmission works, which is $12,300, minus the Blue Book value if the transmission doesn't work, which is $11,000. So the marginal benefit of fixing the transmission in case of scenario B is $1,300. So in the case of scenario B, we do not have an incentive to pay the $1,400 to fix the transmission.